Thank you for joining us at this riveting panel speaking about the institutionalization of Bitcoin, something that we've been talking about since I got into crypto in 2015, and something that seems to be very, very, very slow on the uptake. And that's, I think, what we're going to speak about today. I think we're going to spend our time talking about the institutionalization of Bitcoin. Is it important? And what are the barriers that are in the way to getting Bitcoin institutionalized? I think before we proceed, maybe just quick introductions of who you are and what your interest is in the institutionalization of Bitcoin markets.
My name is Rosenblum, one of the co-founders of GSR. We were one of the first algorithmic traders in the space in 2013, and to this day we trade our own capital for proprietary purposes. We also market make for issuers, exchanges, and we have an OTC desk.
All right, enough of a sales pitch. Over to you.
Hi, I'm Wittenborn. I spent a decade on Wall Street writing research and trading. Most recently, I was at Point72 Asset Management, and currently I'm working at Velocity Markets, which is basically bringing some institutional tools to the retail trader.
Colin, you've got a 2-month-old business in the space.
Well, same here. My name is Colin Zhang. I'm CEO of HashKey Trading, which is we provide liquidity to all the crypto assets. Now, the bigger HashKey Digital Asset Group, which is an offshore arm of Wanxiang Blockchain in Shanghai. So we work out of Hong Kong. I spent about 25 years in investment banking industry, trading foreign exchange and fixed income products.
And for those of you who don't know me, my name is Neuner, or you may know me as Crypto Man Run. I run the world's only televised cryptocurrency show on CNBC. It's called Crypto Trader. I also run a fund and I run an accelerator program in New York City. This Bitcoin bull run, and I say Bitcoin bull run because it really is a Bitcoin bull run. Is it the institutions coming to play? Rich, I'm looking at you because you'd be the funnel for the institutions.
I think it probably depends on your definition of institutions. I think that if you count the suppliers, it's the miners, they're also institutions. I think one of the main drivers of this last few thousand has been that the miners aren't really selling, they're holding, and they're borrowing money to produce more for the future, so it's helping the rally in the short term. I'd say that it's a mix. There's no smoking gun on the demand side. There's certainly retail participation, so it's not 100% institutions, but I think there's more institutional buying now than ever. As we have the custody in line, we have more institutional exchanges that are getting ramped up. So I'd say one of the main drivers is institutional.
So I hear you when you talk about the custody being more in line, and it definitely is more in line than it was in the previous bull run. But let's look at the previous bull run, 2017 bull run. Let's agree that that bull run was 90% retail money, and probably 10% what we call institutions. B institutions, VC companies, funds, etc., etc. This bull run, what does the 90% become and what does the 10% become? In other words, how much more institutional buying is there by virtue of the fact that all these things are now in place? I'm willing to open that question to you guys.
I'm happy to jump in here. I think this bull run in 2019, it's not just the institutions, but we also have to look at the overall macro story. Global central banks, be it Fed or ECBs or BOJ, even PBOC, sort of going back to the easing sort of a policy stance, as well as starting a QE. So I think that's very similar to what we saw back in 2017, where the markets were pretty much in a Goldilocks scenario, where all asset classes go up, all prices go up. That could be one of the reasons, part of the reasons that this bull run in 2019 that so far had sustained itself. Now, the second half of the year, we don't know what the policy stance is going to be. I'm hoping it will continue to be that, and Bitcoin prices will continue to go up. When you say institutions, I think the other parts of the answer to your question really, when you say institutions, I think if you define that as endowment funds, hedge funds, family office, etc., we do see an inflow in 2019, a very strong inflow, by the way, into these funds. So investment capitals go to venture capital firms, and the risk capitals go to hedge funds and endowment funds and the hedge funds. So I think Yes, the answer is, to me, institutional players in 2019 really stepped up. If you look at some other indications, one of them is CME's futures open interest. That's gone up quite a bit. There were accounts applying to CME to trade the futures, and those account numbers have gone up as well. These are solid indications of institutional players in the market because CME account holders are all institutions like us. So I would say, to your question, yes. I mean, that's a very clear sign. The institutional influences in 2019 markets are very strong.
Chris, what do you think? Is this institutional buying pressure, as Colin defines institutions, or is this still the retail investor buying from his Coinbase account or his Binance account? Or
yeah, I think it's very important to delineate crypto institutions versus traditional Wall Street institutions, because I think the crypto institutional buyer was purchasing throughout the entire bear market. And to Rich's point, I think right now it's a little bit more of seller's exhaustion. People have accumulated and the sellers just aren't wanting to sell, whether it be a variety of reasons. If you believe that Bitcoin's digital gold, all the QE that's happening throughout the world, that would bode favorably for Bitcoin as an asset class as well in that specific situation. So I think relative to 2017, long answer short, in 2017 there were hardly to no actual Wall Street institutions that were touching this, and it's pretty impossible to go lower than zero. So I would say that, yeah, people are kicking tires on it, but in terms of widespread adoption, there's a lot of headwinds that they're facing, whether it be custody, regulatory, et cetera, et cetera.
I always say that CNBC is a good barometer for what the institutions are doing, the retail investors and the institutions. Now, if you remember in 2017, CNBC started to introduce crypto to the show called Fast Money and maybe Squawk Box. And they started off by having one segment every now and then. Then they went to one segment every show. So there was a Bitcoin or a crypto narrative, one in every show, which meant about 10 minutes of every 60 minutes. Today, every single CNBC show, options, futures, Fast Money, Squawk Box, every single one of them is overweight towards Bitcoin. And the question is whether that is going to filter down to the institutions to say, look, if you watch the media is talking about this very much overweight. Are institutions going to start moving their portfolios much more into that because of the journalism? What do you think?
I think hype can always help grow awareness. Is what people are focused on. But as far as will the institutions follow the hype, one of the institutions I know something about is Goldman Sachs, where I was for a dozen years prior to GSR. And I think there's this construct that it's more about their philosophy and whether they like Bitcoin or whether they're bullish Bitcoin. Meanwhile, it's more just a business decision whether the market's big enough. There is some, is it on brand to be involved? I think the bigger decision is, how big is the market? And if it's a $50 billion market, like it was towards the lows a few months ago, it doesn't make sense to replan the company and enter, because that's not even a bigger stock. But once we get to the few hundred billion or half a trillion, is where we're closer to now for the industry at large, then I think you start to put more of your resources towards it. So it's less of an emotional response, and it's more just a business decision.
Let's talk about the reasons why institutions would claim that they wouldn't get into Bitcoin. The most obvious one is that Bitcoin is a Ponzi, it doesn't really work, it's tulips. I think that excuse is out the way. Can we agree that now Bitcoin is actually a real asset, and institutions are starting to look at this and go, actually that's not drug dealers' money, actually that's not a tulip thing, this thing may be real. Are we comfortable that we're past that stage?
I don't know, has Warren Buffett had his lunch yet with the crypto team?
I hope that the one thing that comes out of that lunch is that he buys Bitcoin and doesn't land up buying Tron or anything like that. So we can agree that asset managers today or institutions today actually see this as a real asset class. Okay. Do you think that we've solved the custody problem to a good enough, is the custody solution in a good enough place that the big institutions can say, we're comfortable that we have a real custody solution?
I'd say not quite.
Not quite.
If you look at the custody landscape in terms of where it's at right now, to be a qualified custodian, which is what the large asset managers require, there's two options with which you can do it. You can either go through the state trust process, which is what we've seen through whether the South Dakota, Nevada, and New York trusts, or you could go through FINRA and the SEC in that process there. And so I think in order to become comfortable, a large buttoned-up Wall Street institution is going to want to see the likes of a Fidelity or a State Street or a household name attached to that custody solution, and most likely via the channels that they're more familiar with, which would be the more of the FINRA and the SEC route, and slightly less through the statutory trust. So I think if we are talking purely on the institutionalization of Bitcoin, I do believe that that's a headwind for that aspect, but I do believe that relative to 2017, the custody solutions, the insurance provided, and everything under the umbrella of custody right now is light years ahead of where it was.
I want to separate custody and insurance. So what you're saying, from a custody point of view, you don't believe that we've fully checked that box yet?
In terms of the topic of institutionalization and whether or not Wall Street firms want to rush into this market, I would guess that there is some apprehension around these state trusts and the way that they're operating.
Colin, I see you nodding. Have we checked that box?
Yeah, so I kind of agree with Chris. I think we made big progress in 2019. 2-3 years ago, you probably only have 2 to 3 names. It's relatively unknown. It's regulated name, custody names, but relatively unknown. Today, we probably have 4 to 5. I can remember BitGo, Digital Asset Custody, Coinbase offers that, Fidelity offers that. So by the end of this year, you're probably looking at 7, 8, 9. It's a big improvement. At the same time, these crypto assets are being not just regulated, they are, I know you said you want to separate the insurance, but they are insured. The crypto assets are insured, right? By EIG, by Allianz, by, what's the other one, Lloyd's. So I think we made very big progress. Now, is that enough to satisfy large institutions' needs? I think, again, we're going back to the definition. Do we consider the banks large institutions? Of course they are, but are they going to be satisfied? It's probably not. But if you look at the other buy-side firms, endowments, hedge funds and smaller hedge funds, and some of the family offices, I think that probably, the conditions are met.
It's hard to define institutionalization in something that's truly global, when institutionalization in one jurisdiction could mean something in a different, and the rules and regulations associated with it mean very different things.
Yeah, I think for the purposes of this discussion, we should probably take the middle ground, because when we could philosophize for hours around what institutionalization is. All right, so custody, we're lukewarm on custody. Trading solutions, is there an institutional grade trading platform that we believe that institutions are comfortable with today?
GSR, we've spent the past 6 years building one, and there's a whole host of institutions that we trade with daily that trust what we've built. But I think that there's another 24 out there. There's third-party solutions that you could outsource or whitelist. Everything's evolving in the same way. I was going to mention on custody, there's some solutions that take 2 days for you to get out of cold storage, but I think it's going to be better if in a year it could take a matter of minutes. I think on the trading side, we're decades behind where trading is in traditional space, but within a couple of years, I think we could already be close to being on par. So there's fast evolution happening today.
So the way I like to look at institutional investing is I always imagine the guy who's standing in front of the pension fund investment committee, and he has to answer as to why he did something after the fact. So what do you mean? You mean you bought this digital asset that you weren't even holding and it disappeared, it got hacked? So this is the framework for the question. The question is, could he defend himself that there are enough institutional grade trading platforms out there to justify buying the asset? And I think what you're saying is the answer is yes, but they're not as sophisticated as traditional trading systems.
I think no matter how much someone purports they have a good system, unless you see it in work, you don't know how good it is. And ours in 6 years haven't had any issues, haven't had any tokens hacked or stolen or missing. So I think there's some new solutions, but until they're tried and tested, it won't be as clear that they're they're functioning.
Okay, Chris, any comments on the trading platforms? I mean, do you think that the institutions are ready to use the platforms that are out there?
Yeah, no, it's interesting. I've been talking to more people that have provided traditional technology in the markets that are starting to kick tires on the crypto. So I think, yes, I think the OTC desks are the way to go right now, the relationships associated with it. They know the liquidity and the market dynamics better than anyone else. And I've been amazed over the past year, the speed with which derivatives and structured products and more sophisticated institutional type instruments have entered the marketplace and gained a lot of attraction and popularity, which gives that pension fund manager a little bit of optionality with which they can use to hedge their position if they want to take a more cautious approach.
So I guess trading solutions, there are two, well, to me, there are two things, right? One is on the exchange side. When we talk about trading solutions, we really talk about technology. So on the exchange side, and I think the exchange technology, they aren't really that great, right? I'm sure all of us have that experience with all the exchanges. The speed is slow, the data is really not there. I think in terms of the speed, the scale, and the stability, exchange technology really needs to upgrade. Now, if you're talking about trading solutions for buy-side firms or OTC firms, market makers, etc., HashKey is literally, we just started 2 months ago, and we're right in the middle of hiring devs and writing applications, writing trading platforms, etc., etc. Coming from a foreign exchange background, one thing I noticed is that all of the trading solutions that we have, and I think the technology was 30 or 40 years old, but you can still transpose them into the crypto world and reuse that as your starting point. And you got to tweak and you got to make adjustments, but at the same time, I think that technology can be used into the crypto. So I think with more institutions coming into the market, they will bring in more advanced technology, more mature technology, and would in turn help the whole pie grow bigger.
I want to talk about something that institutions or traditional financial institutions are very au fait with, and my personal opinion is that maybe in crypto we're missing some of it, and that is sophisticated instruments, options, derivatives, etc., etc. Do you think that crypto has enough sophisticated instruments to lure the institutional investors? The reason why I ask is I spent some time with a fund manager who manages in excess of $1 billion worth of traditional funds, and said to him, you should really start looking at how you're going to trade Bitcoin when your fund eventually trades Bitcoin one day. And the first thing that he asked me, he said, are there enough options for us to trade? Are there enough sophisticated instruments for us to get involved in this game? Where are we when it comes to these sophisticated instruments?
There's certainly a sequencing to liquidity and the sophistication of it. And you need a borrowing market to have a futures market. So last year, I think we saw the surge of the ability to borrow, some different institutions that would lend, and you saw the futures market come about. Then this year, you've seen the resurgence of the options market, vanilla puts and calls. We've been working to bring the exotics market. It's hard to have exotic options like binaries, variance swaps, accumulators without the vanilla product, but now that there's somewhat of a vanilla product, we're working on what the next step would be. So I think that exactly like you said, if you're a fund manager, especially or a pension, the worst worry is that you bought something and then it went to zero. So with a derivative, you could buy the underlying and then buy a put, so you know you have capped downside.
The borrowing market. There is a borrowing market in crypto. It's, as you say, it's about a year old if you look at it in its real format. But the rates are pretty high. I mean, to borrow crypto today, you're paying anywhere, if I understand correctly, between 6 and 9%. I think if Alex Mashinsky is still around, he'll correct us. I mean, that's high. Paying 6 to 9% to borrow to create sophisticated instruments, that sounds like a high rate.
It really depends on your perspective, because in the borrowing and lending market, who's the borrower and who's the lender? Many people, they're loaning their own crypto to borrow cash. They might think it's a high rate that they're paying to lend their crypto out, but on the other side, the person's getting a great rate, they're receiving it. So I think that it's usually these collateralized agreements. You could have one of equal, where if somebody wants Bitcoin, the other wants cash, there might be no interest rate. It's just the going rate, supply and demand of anything.
Chris,
I mean, I can't help but laugh, but everything seems high in the era of zero interest rate policy, right? So 6 to 9% actually doesn't seem that crazy to me on an asset that's as volatile and can triple, much like Bitcoin has recently. So I think the infrastructure's there. I think that the more market participants that enter, the more efficient the rates will become. And the other thing too is market makers will make markets in anything. I mean, you can buy weather derivatives. I mean, when there's a market to be had, someone will make you a market on it and take the other side of that trade. So I think, you know, the step one is even just like the lowest common denominator that the Morgan Creek guys are kind of pushing. A 1% allocation in Bitcoin increases your portfolio returns by several hundred basis points while lowering your Sharpe ratio. I mean, it's hard to argue with that. And if you have a need for more sophisticated products, have at it. But I also don't think that sophisticated products and is necessarily 100% always required for institutions.
Let me ask you guys a question in this regard. If you were sitting in or the guys that are sitting in the big banks today, they see that there's this digital asset revolution that's happening. Why aren't they quicker off the blocks to start creating these instruments themselves? Why are they leaving it to people who've left the banks, people like us, to go and create it? Why are they not doing this internally? What are they seeing that we're not seeing? Or is it completely all about regulation and lack of regulation?
I think it's more of the latter. I think many of them have the desire to enter, but it's a different market in Bitcoin and crypto than typical assets, because it started off as a whole retail market, and there isn't much legal precedent to go by. So with the lack of legal precedent, it could take a JP Morgan several more years to enter properly. But they'll have a representative, and they're constantly speaking to the crypto financial institutions. And I think that the shot from the bow was the Libra announcement last week. None of the banks were asked to be involved. There's 28 members. There's sure to be a response.
Colin, what did you think of the Libra announcement? Is that enough to bring the institutions into digital assets?
Yeah, let me just add to what Richard said about the banks. That's a great question. The banks were there last year, and then they came into the market. They want to set up the prop shops and market making broker dealer shops, and they wanted to sort of trade for their clients. And eventually, towards the end of last year, a lot of them sort of just disappeared, and that whole thing just gone away. I think one of the issues was, the Bitcoin prices was collapsing, regulatory uncertainty, or rather the lack of any regulation in this market was one of the key reasons they are not there. And I think the banks, especially the large banks, can adopt a fast follower strategy. In other words, they don't need to be there as the first person. They can sort of they can afford to wait and see when the market does take off. They can very quickly mobilize the resources, be it human capital resource or technology or balance sheet, risk capital. They have an army of compliance officers and then can buy into the new products. And very quickly they will be there if they decide to. And I think, I'm talking from our angle of setting up the firm. There's really a large cost of hiring compliance officers and legal. The banks can do that very easily. Now, I think part of the reason that they take this approach is that you really have to weigh the profits that you can generate from the whole market. The Bitcoin market valuation, the capitalization is still relatively small if you compare to any other traditional asset class. So I think it's prudent, I guess, to take that approach. Libra is interesting. It's an interesting project. I think what Richard said was, I agree with. I sort of had the same observation. None of the banks were part of the 28 or 38 founding members of this Libra committee, and that's for the same reason. The regulation is unclear. I'm sure these banks, when spoke to Facebook, and they probably at this point still at a point where you're just going to have to go over the regulatory hurdle.
Do you think that it was deliberate on Facebook's part not to include banks in the 28 key validators? Do you think that they sat in a room and deliberately said, we're excluding the banks because we're about to eat their lunch? Or do you think it was a case of Facebook saying, look, the banks are under too much regulatory scrutiny, they can't play with us?
I think, I don't think they deliberately exclude them. I think conversation must have happened. To that extent, my view is that if Facebook is facing lots of regulatory hurdles to get this thing going, and by the time that they manage to get over these hurdles, they can effectively become a bank themselves. The cost of satisfying the regulatory satisfying the regulatory guidelines and set yourself up, you spend that cost, you might as well become a bank. Once you become a bank, it's much easier to talk to other banks. I could be completely wrong here, but that's my view.
Facebook may be the biggest bank without a banking license very, very soon.
But with a huge reserve.
Yeah. Chris, what do you think? Do you think that LibreCoin is a good thing for the institutionalization of digital assets?
I think it's really too early to tell with too few details out there in terms of the meetings that they need to hold. Is there 28 or whatever it is, group of 28. I will just say that crypto is still looking for kind of its killer use case, right? And the more we prove utility, the more people are going to desire or covet those sorts of assets. People desire assets that have utility, and I think that no matter how you shake it, and it's early to tell, having several billion people across the world with access to some sort of crypto or digital wallet is enormously bullish, even if it is, who knows how it's going to play out.
Do you think that Facebook will add Bitcoin as one of the assets that the Calibra wallet can actually take? Too soon to say.
Flip a coin.
So we've got about 3 minutes left, which leaves me with about 1 minute for each of you. And what I want to do with the last minute for each of you is I want to flip the tables a little bit. If you were a pension fund manager today, and you were going to convince your board why you shouldn't get into Bitcoin. Shouldn't. Should not. What would you tell your board today? If the board gave you a proposal and said, we want to make an investment into Bitcoin, we want to put 1% of our fund into Bitcoin, what would you tell them? As people who know what's happening on this side of the world, what would you tell them are the main reasons why they shouldn't invest in Bitcoin today? And the reason why I'm asking this is because that will give us insight as to the barriers that this industry has to cross before we can actually get every pension fund owner to say yes.
So it's generally too speculative. I think for a large pension or endowment, they have long-term goals of gradually accruing the funds of that they're holding, and something that can go up 1,000% can also go down 99% in a year.
I'm not sure that's a great argument, and I'll tell you why. The internet in 1996, 7, 8 was also very speculative, yet out of that came Google, Amazon, et cetera, et cetera. I mean, just saying that I think it's too much of a speculative asset, that probably could have been a good excuse last bull market, but Bitcoin's not going away now. It's not speculative anymore. But I mean, be that as it may, yeah. Chris, what do you think? What would you tell the board? What's the main reasons why today we shouldn't invest in Bitcoin?
It's a great question. I'll try the old interview trick of taking a negative and spinning it to a positive. I think in terms of the trading resources, if it was a huge institution or a pension fund, I think just given the enormity of their scope, the slippage of getting in and out of trades, and the size with which they would need to enter, they would be the whales in the room, moving the market single-handedly and setting the prices. So I think that would be very, very hard to manage.
That's an interesting point. That's the point that you brought up in the beginning of the discussion, where you said the asset class is too small. Any big institution that wants to make any meaningful investment would actually move the market too much. And that means that if you start buying now, by the time that they start buying, you'll get all the upside. Colin, over to you.
I guess the solution to the question you just posed is really just to scale it down, right? You really just buy 0.1% of your pension size. And I think if I have this proposal from the board, I would tell them to invest in blockchain companies that potentially can benefit from the Bitcoin markets. I mean, that's a win-win. That's sort of a win-win situation, because if 20 years later or 30 years later, when pension fund becomes due, or the payment, you got to make the cash payments. Hopefully, the company cash flow on the blockchain company will be able to satisfy your investment guidelines.
I did have one more question, but Peter's told me that the time's up. So I'm actually going to ask you the question. Do you think it's more risky for a pension fund manager today to hold Bitcoin or not to hold Bitcoin?
Not.
Not.
Right.
Thank you very much.
Thank you, guys. That was amazing. Thanks, Ryan. Always a pleasure, man.